Welcome to the D-Risk Weekly Global Markets Brief. It is Saturday, December 20th, 2025. Last week, we discussed the recession reality check, where markets finally woke up to the dangers of slowing growth. But in a stunning reversal, this week the narrative flipped again. We have moved from fear of a slowdown to a celebration of lower prices. The theme of the week is the deflationary melt-up. Here is the contradiction defining the moment. Crude oil is collapsing, signaling industrial weakness, yet technology stocks and gold are rallying in unison. Why? Because the inflation data finally broke. The November CPI print of 2.7% came in softer than expected, fueling bets that the Federal Reserve and global central banks will keep the liquidity taps open. Investors looked at a collapsing energy sector and didn't see a recession. They saw a tax cut for consumers and a green light for lower yields. We are seeing a bifurcation where old economy assets like oil are being liquidated, while new economy tech and hard money gold are being bid up aggressively. It is a dangerous, high-stakes rotation. Alex, let's start with the international picture. We saw massive policy divergence this week between London and Tokyo. How did that play out in Asia and Europe?
Thanks, Sarah. You are absolutely right about the divergence. While the U.S. cheered softer inflation, international markets were whipped around by central banks moving in opposite directions. Let's start in Japan, where the era of free money is officially dead. The Nikkei 225 slid 2.61% this week, closing at 49,507. The catalyst was the Bank of Japan finally pulling the trigger on Friday, hiking rates to 0.75%, the highest levels since 1995. While this was expected, it still rattled the carry trade. Despite the weekly slide, the long-term trend remains technically constructive. The Nikkei holds a golden cross, with the 50-day moving average at 49,774, sitting well above the 200-day at 41,980. However, note that the closing price of 49,507 has dipped below that 50-day line, signaling that short-term momentum is breaking down as liquidity tightens. In China, the Hang Seng Index also struggled, sliding 1.10% to close at 25,691. The data out of Beijing was mixed, a record trade surplus on one hand, but slowing industrial output on the other. Investors are voting with their feet, skeptical that the current stimulus is enough to counter deflation. Technically, the Hang Seng retains a golden cross with the 50-day at 25,967 above the 200-day at 24,664. But similar to Japan, the price is now trading below the 50-day average. The trend is bending, even if it hasn't broken. Moving to Europe, the story flips from tightening to easing. The standout performer was the UK's FTSE 100, which rallied 2.57% to close at 9,897. The driver was the Bank of England's decision to cut rates to 3.75%. Markets love a pivot, and London traders bid up equities aggressively. The technicals confirm this strength. We have a pristine golden cross with the 50-day at 9,655, widening its gap above the 200-day at 9,064. The price is firmly above both averages, validating the bullish momentum. Meanwhile, Germany's DAX was more muted, drifting up 0.42% to close at 24,288. The Bundesbank released a forecast for a gradual recovery, which kept a floor under prices but failed to ignite a rally. The technical backdrop remains supportive, with a golden cross where the 50-day at 23,956 leads the 200-day at 23,596. Sarah, the signal from overseas is clear. Markets are rewarding central bank cuts in Europe and punishing tightening in Asia.
That is the textbook definition of a policy-driven market. The FTSE flies on a rate cut while the Nikkei stumbles on a hike. It proves that right now liquidity matters more than fundamentals. But this brings us back to the United States. We had soft inflation data and a resilient consumer, but we also have an energy market that looks like it's pricing in a depression. Is the U.S. market decoupling from the industrial reality, or is it just front-running the Fed?
The U.S. is decoupling, Sarah, but it is a specific type of decoupling. It is a flight to scarcity, scarcity of growth in tech, and scarcity of trust in gold. Let's look at U.S. equities. The deflationary melt-up thesis was in full control. The Nasdaq 100 rallied 1.24% to close at 25,575, while the S&P 500 rallied 0.83% to finish at 6,887. Both indices are ignoring the weakness in the real economy and focusing entirely on the discount rate. The logic is simple. If inflation is dead, the Fed can cut, and tech valuations can expand. However, the commodities market is screaming a warning. Crude oil slid another 1.36% this week to close at $57. This is not just a dip, it is a structural breakdown. As the data shows, oil is locked in a confirmed death cross, with the 50-day moving average at 59.00, trading below the 200-day at 63.00. Price is being rejected at the 50-day line repeatedly. When oil trades with a $50 handle, it usually signals demand destruction, not a soft landing. On the flip side, gold is acting as the ultimate hedge. It rallied 1.43% to close at $4,361. While oil collapses, gold is surging. Technically, the metal is in a robust golden cross, with the 50-day at 41.39, well above the 200-day at 35.55. This divergence, oil down, gold up, tells us that smart money is betting on deflationary stimulus. They expect the Fed to print money to save the system from the oil bust. Turning to the plumbing, the U.S. dollar index, DXY, drifted higher by 0.20% to close at 99.00. This is a critical technical juncture. We are seeing a convergence where the 50-day moving average is at 99.00 and the 200-day is also at 99.00. The data flags this as a death cross signal, implying the long-term momentum has stalled. The dollar is caught between a cutting Fed and a hiking BOJ, leaving it directionless. In the bond market, the 10-year Treasury yield cooled slightly, closing at 4.15%. It drifted lower from last week's 4.19%, reacting to that soft 2.7% CPI print. The bond market is validating the equity rally, signaling that inflation is yesterday's problem. Finally, the volatility index, VIX, was crushed. It closed at 14.91, wiping out last week's fear spike. We are back in the Goldilocks zone. Sarah, the cross-asset signal is fascinating. Oil says recession, bonds say disinflation, and stocks say party time.
Thanks, Alex. That trifecta, oil crashing, gold soaring, and the VIX collapsing, is the perfect signature of a liquidity-fueled rally. The market has decided that bad economic news, like falling oil demand, is actually good news because it guarantees lower rates. Looking ahead to next week, the holiday trading volume will thin out, but the macro calendar remains heavy. We kick off with UK GDP on Monday, December 22nd, which will test the optimism from the FTSE rally. Then, on Tuesday, December 23rd, we get the US GDP revision. If that number comes in hot, it could challenge the deflationary melt-up narrative by questioning the need for aggressive rate cuts. Also, keep an eye on Japan. On Wednesday, December 24th, BOJ Governor Ueda speaks. After this week's rate hike, any hawkish comments could send further shockwaves through the currency markets and impact the dollar index. Finally, we get Tokyo CPI on Christmas Day, giving us a leading indicator for global inflation trends into 2026. This is a market running on the fumes of policy hope. Watch the oil price. If $57 breaks, the deflation narrative could turn from a tailwind into a storm. That's all for this week's episode. Remember, this podcast is for informational purposes only and isn't financial advice. Do your own research or consult with qualified financial advisors before making any investments. Thanks for tuning in and catch you in the next episode.